you telling me that you have a way to defer the tax situation there? Is that what you're telling me?
Yes, absolutely. Yes. And so the first one I was referring to is a 1031 exchange, which only applies to investment real estate. The second one I'm referring to is called a deferred sales trust.
A real eye opener to see that there are ways that people can feat for me to say, wow, this actually really worked. And it was really cool.
1031 is a way to shelter your income when you sell the thing. The DST is a way to avoid the 1031 and not have to suffer the time penalty.
Our career and during different tax periods, we've seen, these tax avoidance, tax minimization, offshore, all these different strategies undertaken to minimize or avoid taxes. And then I can tell you that, some of them are just not worth the trouble. And so I was skeptical. Admittedly, I was skeptical. I thought, oh yeah, here we go, another one of these, right? And then they say, no, it really is different, right? So look more closely. We looked more closely. We had, honestly, 2 years of conversations. 2 years. Now we were being due diligence at the same time that we were doing due diligence, but 2 years is a long time to be, sort of flirting with the idea of and getting to know the people and getting to really understand the transaction. Yeah, long story short, we got comfortable, although we are not tax attorneys, lawyers, or estate planning attorneys, that at least, from an investment perspective, that, it made sense to sell a highly appreciated asset, get liquid, hold that in this type of a deferred or installment sale type of instrument, and then just be in a position then to do the most important thing. I'm probably stealing your next question, which is time. They say, well, you can't make more time. You can. The Deferred Sales Trust, in a way, allows you to lengthen the investment time horizon for those assets after getting liquid, but before having to feel the tax impact. And from an investment manager's perspective, time horizon is the most important element in investing. A deferred.
Well, hey, everybody. We got Brett Swartz.
Hello, everybody.
With the family. How are you, Brett?
Hey, Jake, I'm doing great. Looks like you cut the hair a little bit, man. It's looking good today. You got a little trimmed it up.
I know. The more I cut off, the younger I look. And I don't know if that's good or bad, but here I am.
I think it's good. I think it's a good thing. You know what I mean? It's and then and also the clean shaving too. I know you were clean shaved last week. It looks like you got the haircut too. So it's probably, every now and again you got to trim it up a little bit, right? You got to clean it up.
And I'm just following the market trends in the sense that everything's changing. I have to change too, right?
Maybe you're more in tune with what's going on with the marketplace. So, Jake, until I'm in a better connection spot and get this.
Absolutely not a problem. We also have Pierce York with us here. And today, the reason we're all here together is to talk about the Deferred Sales Trust, what it is, how it is a financial tool, but how it can be utilized, who it's for, who it's not for. Essentially, most of us are here in the room today because we may know someone or ourselves, perhaps we have a highly appreciated asset that might be sold this year or coming up soon. And if it is sold, we could be subject to a 20% capital gains tax, which goes up to 28% in 2026. Or we could be subject as well, in addition to the Medicare tax, another 3.8%, as well as, if it applies to us, state income tax. So Pierce York, can you tell us a little bit about why we're here today, what our mission is, what we're hoping to accomplish?
Yeah, absolutely. Can everyone hear me?
We can, yes.
Awesome. So, yeah, we are here today for a variety of reasons. The first being that we just really love to look at Jake Miller and his hair. So you look phenomenal, brother. No, but on all seriousness, so what we help people do is we help provide clarity to potential problems that can arise within selling highly appreciated assets and estate tax. And what we're here to do is we're here to provide a community where we can talk through different solutions, educate, develop, and build relationships with one another, and just provide a ton of value in a variety of different solutions, not just the Deferred Sales Trust, although the DST is, in our minds, a cornerstone strategy. And so that's why we're all here today. We're here to learn, grow, and just get comfortable with one another.
Absolutely. Well, my goodness. In just a few words, let's just dive in real fast, and then we'll talk about some real life examples. We'll talk about some live deals, and then we'll open up for questions and answers. But in as few words as possible, Pierce, what is a deferred sales trust?
Yeah, a deferred sales trust is a tax strategy that can be used for any highly appreciated asset. And it's an alternative to a 1031 exchange or charitable remainder trust. It is a solution that provides flexibility. It provides liquidity. It provides freedom from debt. It provides the ability to be an entrepreneur, to enter and exit real estate on a time scale that you can control. And it can even help move assets outside the taxable estate. So it's a deferral strategy that we like to use in conjunction with other strategies to help create, preserve, and grow wealth and keep wealth within the family. Hopefully that was succinct enough for you.
Sure, sure. I'm going to talk a little bit about the how. I just want to talk about Brett Swartz for a minute, because while he's not in really good reception, we got to make fun of him or at least talk about him the very best that we can. Brett, in biblical terms, we're going to call him a tax warrior. We're going to talk about how Brett becomes your shield. And how is it that? Essentially, the how is that a deferred sales trust is a legal tax structure and entity that we put in between the buyer and the seller of a transaction. Typically, the buyer and the seller of a transaction where there'd be a highly appreciated asset that would otherwise incur very high capital gains. High enough that you have enough tax paying that you'd consider the need for a tax warrior like Brett to step in between you and the various taxing agencies to protect that transaction from being recognized in the current year legally. Now, Brett, I think perhaps you might have moved into some better reception. Do you want to say hello and kind of introduce yourself as the role of a trustee and what you do, how you become that tax warrior?
Absolutely. Yeah. Thanks so much for being so courteous with my reception here. We were at the beach with the family today and having a great time. And so, yeah, the main one of the main tenets of the deferred sales trust is to have a third party unrelated trustee who's in the business of essentially being kind of like an IRA company or a 401k company or a 1031 company, where the funds, instead of hitting your personal account as the investor or the owner of the asset, you can loan them to this trust in exchange for a promissory note and receive payments slowly back over time. And it's that delay or that deferral. Another good way to think about the trust is like a delayed tax trust. We call it delayed sales trust because it's almost like you delayed the proceeds from the sales, which is actually what you did. The sale actually happens. And you're saying, well, who does it happen to? What happens to a third party buyer that we line up and or your whatever agent you're working with lines up. And at that point, we come in and we cooperate with the deal. They cooperate with the deal. And instead of the funds going to you personally pay tax, they go to the trust, and the trust owes back the money, and the buyer takes title, and they are happy to take the property or the business with the asset. And that's where the freedom gets unlocked. And really, what we try to teach and coach and encourage people to think about is having what's called a tax flow mindset versus just a cash flow mindset. For the longest times, we've been taught it's all about cash flow. Well, we're here to tell you it's all about tax flow. Now, it's always been about both, but it's more important to focus on tax flow more than ever, especially if you're in the Taxophornia, the New York, the New Jerseys, the Hawaiis. I was on a call this week on a podcast with a gentleman from Hawaii who's that's one of the highest tax states for highly appreciated assets. And people are looking for freedoms to unlock these assets, trade these assets, or just diversify and unlock what we like to call the 10 major freedoms. But that first starts with the tax flow mindset, and not just the cash flow mindset. So that's kind of the kind of quick overview, Jake, and kind of introduction to what I do and how we help people.
Wonderful. Let's maybe talk about a deal case or a real live project that is in the works right now, something that's under review, perhaps has gone all the way to actually speak with the attorneys. Brett, do you have one handy, you or Pierce, that we'd like to discuss?
Yeah, I do. So in fact, Jake and I just closed a deal last week, Jake Miller and I, for a gentleman and his wife who've owned a company for 30 plus years. And it's multiple $1 million sale out of the state of Colorado. And they were looking at, Colorado, I think it's around 5%, but you said it well in the beginning, Jake, it's 20% federal, and you're right, set to go higher, up to 28% in the new year, or another year or so. And then you have Obama of 3.8%, and then you have depreciation recapture. So overall, their sale was in the kind of the mid threes. So you're looking at least about $1 million that would have been tax liability tax there, and that was substantial. And so through the process of understanding who we are, understanding how the legality works, understanding how the investments work, it was about a 4-month time frame from start to finish to closing. He was able to unlock their freedom of not having to be in the business anymore. And that's one of the major freedoms, is that time freedom, because a lot of business owners we meet, Jake, are financially, they're free. I mean, they have the cash flow, or their business is doing really well, but they may not be time free or even location free. And so they're looking at something like the Deferred Sales Trust to unlock that freedom of time and that equity to redeploy. And so that was a nice deal that we closed. And in fact, I'll update you. There's a second one coming here in about a month on their real estate property that they just are about to put. Actually, it's under contract, but they're ready to roll in the second deal into the same trust coming up, and that's going to be an exciting deal as well.
Wonderful. Well, that's a fantastic little tidbit. I'm going to pull out some golden nuggets there. One of the things that you mentioned is that we're in the works with them for about 4 months, right? So it wasn't just from one day to the next day transaction and decision. Literally, this is something that they've been investigating for a long time. In fact, when I got introduced to them a little bit later, they actually said, we feel like we already know you, Jake, because we've watched all your videos. And so these people have done a lot of research with the content that we provided, as well as everywhere else that they could find, so they would have all the right questions and have all the right time, so that when it came to the close of their deal, selling their business, their family business they've been working in for the last 30 or so years, they were ready to go, ready to pull the trigger. The entity was all set up, everything works smoothly. And to your point, Brett, another golden nugget. People ask me all the time, can we use the DST or the Deferred Sales Trust more than once? And as you mentioned, with these same clients, they're looking, first they sold their business, now they're going to sell a piece of real estate. How does that look, Brett? How is it they use it more than once?
Yeah, I'll answer that here in a second, but I think you hit on a good point here, Jake. Our goal of these, masterminds, master classes, deep dive, today we're talking about tax flow versus cash flow, and how, and with the DST is kind of the theme of today's topic, which we're going to dive into a little bit more here in a minute. But understanding that our main goal is to provide transparency, clarity, and most of all, confidence for you to use the Deferred Sales Trust, our team, investments, strategies, but also look at other options as well that might be good. I mean, there's times when we tell people to do a 1031 exchange, or to do a Delaware statutory trust, or do a combination of all three with the Deferred Sales Trust, or do a donor advised fund, or do opportunity zones. And so essentially we're trying to encourage and build the tax flow mindset, as well as skill set of what's even available for you and what's going to help you fit your goals, your ambitions, help solve your problems. And that's the key, having transparency with what's happening, deals that are going on, deals that are closing, the reasons people are using it, the reasons people may not use it, right? As well, number two, clarity on what it is, the legality, the track record. You know, every single week we still have, in fact, we can go over it again, like, hey, my attorney says, is cautious or is concerned, or, says there's big red flags, or all of the different things that come up when people introduce the strategy to a professional of their own that they've known, liked, and trust for years, who didn't know anything about this. Because if they did, they would have told them about it and probably using it, but they don't know anything. And so, and all of a sudden they start to get, some momentum going, and then the mindset of, or the challenge of the other professional comes in. And so this is part of why we want to have these calls, to show, what's actually happening, and to help build that confidence at the end of the day, because this is a serious thing. This is family legacy. This is millions of dollars. This is tax deferral. This is something new. That's part of why we love what we do, because we have an opportunity to make a big difference in people's lives and unlock some of these freedoms. And so, yeah, transparency, clarity, and confidence. Hopefully you guys are all getting that today, and gals, in today's masterclass, Mastermind. Every single week we want to do that. Okay, so to answer your question now, can the Deferred Sales Trust be used for more than one deal? And if so, how? The answer is yes. And the beauty of the Deferred Sales Trust is typically you're going to form one trust, and we'll talk about why you might do two in a minute, but one trust, and you can have multiple deals that are sold and a promissory note issued from that trust. In other words, you could sell multiple assets, whether it be business, cryptocurrency, stock, primary home, save a failed 1031 exchange, and you can be issued a promissory note from that same trust. So in this scenario, the client has a business sale, the first promissory note for about 3.5 million. For the second one, I think it's going to be about 2.5. So we'll have two promissory notes, one trust. And what's neat about that too is now all of a sudden you can consolidate that equity. If you think about that for a second, in the old Blockbuster 1031 strategy, you cannot, first of all, even 1031 a business, but number two, you could never combine the equity to buy a bigger property or bigger business venture or whatever else. In this scenario, we're able to consolidate that equity, pay off any debt that's outstanding, defer the tax, and now there's a pile of not only 3.5 or so, but another 2.5, which guess what? That could be used for a big down payment, up to 80% of that, for an asset purchase, if and when a deal makes sense. Now, these folks are looking to retire, looking to be more passive, and looking to diversify with some passive real estate and some stock market. So we're working through all of those allocations and such. But just that thought and that concept unlocks even additional freedom in case you're an entrepreneur and you're wondering, well, hey, I want to go run my own deals. I want to be able to buy real estate or go into another business venture. You have both freedoms, not only retirement freedom, and I guess this would be a new one, if you will, Jake. It's equity consolidation freedom,
Right.
where your equity is not just tied to these single assets in these different places that are locked up. You can unlock them now, have them in liquid assets and ready to deploy. So you want to add anything?
Yeah, I mean, part of that is asset diversification as well as tax diversification. And back to in the beginning, we had a little video with David Young. And David Young was talking about the power of timing. And when it comes to financial planning, having the power of timing when you need to pay taxes, as well as when you're able to move in and out of assets, is very, very powerful. Literally, it is a game changer for helping people manage their assets. So the Deferred Sales Trust has become quite an important tool, a financial tool in the financial planning process. Because just as you mentioned, Brett, it gives you the ability to move your equity out of real estate into cash or treasury bills or marketable securities or into something else. And you can change the liquidity of your assets as well as when the timing is right, and not because of some other tax strategy, but because of when the timing is right, you can move it into that next business opportunity or that multifamily purchase, or, hey, maybe you get into the business of generating Bitcoin or what have you, whatever the next big thing is for you. You're not pressured to jump in, perhaps when the price is high because of some 45-day, 100-day limitation or requirement. With the Deferred Sales Trust, the power of time is back in your hands.
Absolutely. And I'll also mention two other things about this deal. Number one, it was a C Corp sale. So people are wondering, does this work for C Corps? The answer is yes. Does the Deferred Sales work for S Corps? Yes. Individuals? Yes. Does it work for partnership separations? Yes. We did the $13 million deal in San Diego where four partners of the four, three went with the deferred sales trust, one just paid his tax. So does everyone have to go? No, it's really flexible. And so one of the challenges about halfway through the due diligence was, oh my gosh, this is working for my C corp, and the client was, had some legitimate concerns and questions. And so working with the tax team, the DST tax attorneys, our strategic alliances, we were able to work through all of those things and make it very, clear to the M&A attorney, to his attorney. And the key here is time. So time is kind of a theme in one sense, that if you have enough time to do due diligence, enough time to introduce us to your professionals, and by the way, we want to encourage you to do that. A minute ago, I talked about one of the biggest objections that people have, and one of the biggest things to overcome is, hey, I either need my professionals to say yes, or I'm just really surprised that not everyone knows about this and everyone's doing it, and my professionals didn't tell me. I thought I had some of the best, and I'm sure some of the best at what they do. But if we have enough time, we have found we love to collaborate, we love to cooperate, we love to work with them. That's part of why we work on a no-cost due diligence basis, 100% no cost. We work with all of your team, your estate planning attorney, your M&A attorney, your CPA, and we will step by step educate them on what it is, how it works, all of our references. We have enough time, and the way I like to see it, Jake, is if we have about 5 hours of your dedicated focus, that first hour is the introduction call, just really discovering, what are you trying to do? Where are you trying to go? What are your ambitions? What are your major challenges? What is this, equity mean to you, and how does it work for your family legacy long-term? Number two, 1 hour to deep dive into your actual deal itself to find out if it qualifies. By the way, we need to have $1 million net proceeds, $1 million gain is our minimum. So we want to deep dive into that, but also just the timing of the sale and the structuring of the sale and who's escrow and who are the agents. We might be the agents ourselves to help you make sure that it's all very clear and crisp. All of the details that have to do with the actual transaction. The next hour, the third hour, is really deep dive into client references. So where you can speak with our clients, talk with our clients, hopefully attend some of these master classes here or masterminds. And once you start to see that really looks good, that also includes talking with the bank. And then we're diving in the next hour with typically Jake Miller, a financial advisor, looking at investment allocations, maybe talking with some real estate companies. And then the last hour would be just making sure that we have a clear plan when they execute and sell the asset into the trust, the execution of the allocation of the investments and the payback schedule. So that's just a quick, 30,000 foot overview of how we do work. But the key here is time. So if you're listening to this, you want to get with us early, and you want to connect with your team and the people you're working with early, so that we can make sure everyone feels as good as comfortable as possible and feel really confident about what's going to happen.
Absolutely. And I think that's the biggest thing is, if this is going to be one of the largest transactions of your life, or perhaps large enough that there's enough of a tax pain that you're willing to spend the time and effort and research to vet the strategy and to vet the people, and then to work with us on an ongoing basis moving forward, because this can be a fantastic and very vital financial tool in your investment planning going forward, then you should take the time necessary to get to know all of us, to as this past client that we just talked about did, spent hours and hours and hours of watching our videos. And that was impressive. I was impressed. He knew more about me than I knew about him at that point. That's not always the case. So it was kind of a fun little conversation that we had when we first got to know each other.
And that being said, we have an event coming up with one of our strategic alliances, DLP Capital, in New Orleans, and everyone's invited. It's at the end of March, and it's their legacy kind of wealth building event. So there'll be leadership, there'll be legacy, there'll be wealth, there'll be commercial real estate. And it's going to be an amazing event downtown New Orleans, March the 22nd to the 25th. And so if you're interested, reach out to us, and we'll let you know about all the details there. That being said, Jake, you think it's a good time to open it up for questions from maybe any participants here? And by the way, you can ask your questions in the chat, as well as you can unmute yourself and you could ask about anything we talked about. It could be a live deal, it could be a deal, that potential deal, whatever, comments, thoughts, it's all welcome. We're here for you. So why don't we do that, Jake? What do you think?
I think we should, but very first, I think we should let Pierce, I believe, Pierce, you have a special guest, is that correct? Oh, Pierce might be running out of signal. Let's see here.
I do. Yeah. So I don't want to put him on the spot, but yeah, I got a friend in here if he wants to speak up. He's more than welcome to, but we were kind of talking about some really cool stuff, and he's got a really interesting kind of case going on right now. So I won't out him, but if you're listening and you want to ask questions or whatever, now's a good time. Love to kind of deep dive into some of the questions you got and see what we can kind of work out.
So the invitation is open to everyone. Anybody that would like to ask a question and say hello, feel free to do so.
Hi guys, Jim Kubiak here out of Western New York. I really appreciate you guys having this master class. For some of the questions that we've come across, I'm sure other people on the call, have had some of the same results that we've had. The DST is this great vehicle that almost nobody in our location knows about. And so we've spent some time this week speaking with, representatives and attorneys that were, different than the ones that we've used before. And so going through this, I had a couple of kind of short questions. I'll ask them all in a row and then get off and let you guys, discuss. This may be a silly one, but it's one that I wanted to ask. And that is, any chance the IRS, changes this at some point once we've already moved forward, and what would be the ramifications of that? The second question would be, if you're compounding the interest over 10 years, is that additional capital gain? And how is that kind of reported? And then the last would be, in tagging this to a living trust for family members, what would be the tax ramification of that coming over to our children? And I'll take your information offline. Thank you.
Yeah, well, actually,
Thanks, Jim. And I'll tee up Jake to start off here, and then I'll carry a couple too.
Yeah, I was going to say, Brett, let's tag team that a little bit, but Jim, don't go away.
You guys all hear, Jake, can you hear me okay still?
I can hear you just fine. Can you hear me okay?
Okay, now you're coming back. Yeah.
All
Thanks,
right.
Jim. Good questions. And from Taxifornia, we welcome you guys from New York, New Jersey, man. I mean, it is a big burden with the taxes, right? So, but hey, some good Americans got to pay it, but hopefully we can defer it and grow the wealth and do it through business creation and real estate creation, right? So, but let me tee up Jake on this first one. So Jake, for people who don't know, Jake Miller, he not only is a certified financial planner, amazing dad and husband for his family, but he's also in the Army. He served, but as well, he took a position that not a lot of people get to take, and that position is this: over 400 CPAs, firms, and CPAs across the country hired him to lead an elite group of extensive due diligence on tax deferral strategies or other strategies in general. And they would basically bring up some of the best ideas that they could find and ask Jake to do a higher level due diligence to find out which ones he thinks could be viable and reputable, because you can imagine there's a lot. And so he did that, and he's, I think, over 4,000 strategies. I think it was the number, maybe more than that. But Jake was exactly tasked with this. So Jake, with that being in mind, do you want to cover the first question with, hey, what happens if the IRS were to potentially, change a law or change something? Would the Deferred Sales Trust go away? What are the odds of that? What does it look like?
Absolutely. Well, first and foremost, the IRS can almost do anything that they want, right? But let's look at the historical, everything that has happened up until this point. When we do due diligence on a strategy, when we look into whether or not this group of CPA firm owners should promote a strategy to their clients and take on that risk of saying, hey, our firm will back this strategy because it's a suggestion that we're making because it has really good tax ramifications that can benefit our clients, et cetera. And if there's an association of, actually, Brett, it was an association of 10,000 CPA firm owners, but I was, yes, correct. You mentioned attached to the top 400 in the firm that had to deal with clients that needed these higher level strategies. Of all the strategies that I came across, there were only 2 out of so many that had a 100% track record with the IRS to date. To date. That's very, very important. What do I mean by that? Well, they've been around long enough to be tried and tested. What does that mean? That means that, there's been more than 2,000 or 3,000 of these done, because out of every 2,000 to 3,000, there's been an audit. Somebody's name has been picked out of the hat randomly, whatever, and it's been looked at, it's been reviewed. Well, this one has been reviewed not just once, but it's been reviewed or high level reviewed or deep audited up to 22 times in the last 26 years. Now, what does that mean? Sometimes a cursory review is, hey, please send us some information on this transaction. We just want to validate that you have some documents. Or it could be a deep dive audit, such as a $120 million skyrise condo apartment building in California. So whether it's $120 million or if it's just, a $500,000 piece of real estate somewhere, whatever it was, the IRS has looked at this a number of different times. And here's the magical thing. Every time that they've done so, and again, history is no predictor of future outcome, right? They say that a lot in the investment world. In the tax world, it kind of is, though. Bear with me. Over 22 times, the IRS has looked at that. And every single time, it's had a 0 findings and a 0 change result. That is like a building inspector doing a 4-way, which, by the way, this almost never happens, where they pass with flying colors the first time. But this strategy has passed with flying colors every single time. And that is almost unheard of in the tax strategy world. Usually in the tax strategy world, you try to align when it does work with when it doesn't work and start establishing a set of rules of how you should properly recommend that people partake in this strategy, and all of the disclaimers of when it may not work and how, even though we're guiding you along the path of where we think it might work, there are these risks that it still might not work. Well, that doesn't exist with this strategy, in the sense that Todd Campbell with Campbell Law, who invented and created this strategy 26 years ago, has personally defended it. And his fees that we pay every time that we do one of these go towards the lifetime audit defense, because he has a motivation to retain this 100% track record. He's batting 1,000 so far. And that's very, very, very important. So could the IRS change something in the future? They always could. It is not likely that a change in tax law, since this is around 26 years, would actually affect this strategy because of the number of precedents that it already has. Now,
and maybe add to that too, Jake, real fast. Is that all right? So the actual tax law people are running is IRC 453, which is known as an installment sale, which actually goes back to the 1920s and 30s. It's a seller carryback. Like, I mean, we all know seller carryback if we're in real estate. Your CPA definitely knows seller carryback. What Jake is referring to is the 26, almost 27-year track record now. It's the deferred sales trust using the installment sale method of IRC 453, coupled with a business trust, and collectively that's called a deferred sales trust. And so the question is, well, can there be business trust and can there be installment sales and can they be mixed together? Right? Well, there's trust of all kinds. There's living trust for probate. Right? Ours happens to be a business trust. Is there installment sales? There's installment sales every single day. And it goes back many, many years. And by the way, why are installment sales even put in place? If you think about it, what happened during the Great Depression? Part of the banks seized up, and part of that was because of people just ran on the banks, right? Now, the government says, how do we incentivize a common seller of an asset to sell if they have to pay a ton of tax? Well, why don't we let them to not only lend the money, so they don't have to rely on banks, right? And number two, why don't we incentivize them to sell so the money continue to flow into work? And that's part of what we have to follow the rules. Funds need to be invested into businesses or investments that spur economic growth. By the way, it's the same concept of IRC 401k, which is a tax deferral strategy for retirement purposes mainly, but also so that money just gets spent. It gets pushed back into stocks, bonds, mutual funds, or real estate, something that's going to produce more jobs and definitely more tax revenue over time. Same thing with IRC 1031 exchange. So these are things that the government doesn't do very well. They give us the opportunity to do them as long as we follow the rules. However, most people don't know about the deferred sales trust, partly because it's proprietary. Number two, it's protected. Number three, there's only one law firm. And people call Jake and I all the time, and even when Jake's positioned, to present or to show these things to our clients and to our audience. And it's really 7 questions. In fact, I have a YouTube video on this entire thing. There's really 7 questions you want to ask of us in any major tax deferral strategy. And Jake covered a number of them. How long have they been around? how many have closed, how many IRS audits, who actually had the audits, who did the audits, what attorney did the audits, what was the outcome of those audits, but more importantly too, what happens if I get audited? Part of the cool thing with every deferred sales trust is a thing called lifetime audit defense, state or federal, right? From Campbell Law, who has a perfect track record. Number two, what if, but Jim, what if someone just says, you know what? The government is still going to shut all of these things down. What are the odds that they don't grandfather people in? That's the other thing too. The odds are if you did it today, and they're probably going to grandfather you in, right? That's more than likely. Can't guarantee that, but that almost be like saying, hey, we're going to eliminate the 1031 exchange, and we're just going to eliminate everyone who's ever done one, right? So is that making some sense, Jim? Do we answer that first question? Do we have a thumbs up there? Fantastic. So Jake, good job on that one. Maybe we should go into the second question, which was, what happens to the capital gains on the interest above and beyond the promissory note? And let me just take this one. So this one is interesting. So it all depends, Jim. The trust, for example, year in, year out, generally speaking, typically operates at a loss. Why is that? Let's just say it was a $10 million sale and that interest rate was an 8% interest rate compounding that was owed back to you, Jim, if you were the seller and you were owning the promissory note. The trust itself owes you the 10 million plus that 8%, $800,000 per year. So it's invested. So the question becomes, how are we doing each and every year? And how much are we paying you out? But guess what? The trust is able to do on its own tax return. It's able to offset an expense, that $800,000 of accrued interest, regardless if it's paid you yet and regardless if it's been earned yet. So each year it's kind of going like this. It's going to sometimes it might be 12%, it might do 8%, it might do 6%, it might do 15%, and it's doing this over the 10 years. But generally speaking, with the fees and with the interest rate that it's accruing at the trust tax level, it operates typically at a loss. And also remember too that it bought your asset for 10 million and it sold it for 10 million, so it has no gain at that level. Now, fast forward, your question was, well, what happens if still there was additional? So let's imagine we were hitting, 10, 12, 13% year in and year out, right? And we just keep hitting all of that, and that covers all of our fees, and there's this excess left over. Yeah, could the trust pay tax? Of course it could, right? It could at that point. The odds of that compounding every single year, depending on your risk, depending on the performance, it could happen. Now, here's the good news. If that were to happen, part of what here at Capital Gains Tax Solutions is we operate out of Nevada, and that's for a strategic reason. Okay, Nevada has no state income tax, nor has any state capital gains tax. Does that mean it couldn't potentially still pay tax for federal? Absolutely. It's federal. That's part of that. So that answers that second question. Jim, do you feel good about that one? Can you give me a thumbs up? Okay, great. Jake, I'm going to give you the third question, which has to do with the living trust. The living trust. So Jake, what happens? Hey man, like I got this 10 million, it's paying 800,000, but I die. What's going to happen to my heirs? Are they going to be taxed? Do they get a stepped up basis? How does that all work for the next generation, Jake?
Absolutely. Great question. Now, a lot of this depends on timing in regards to the value. Let's talk about that just real quick. In the very beginning of this transaction, Jim, we exchange the property into the trust, the property or the asset, whatever is being sold, right? We exchange it into the trust. Well, in order to exchange it into the trust, we have to replace it with something. We replace it with a promissory note. That promissory note stays inside of your estate. And if we use the DST 2.0, the asset that goes into the trust now is outside of your estate. For purposes of wealth building, now we're able to accumulate and build wealth inside of the Deferred Sales Trust outside of your estate. And your heirs, with your family trust, your heirs can, because of the promissory note that is in your estate, your heirs can assume that based on normal estate laws, estate planning laws, all those other things. When one asset passes down to the other, you can, as the current creditor of the corpus of the trust, pass that on to your heirs. And even should the assets in the trust go up dramatically over time, it's grown outside of your estate. So this has actually assisted in the estate planning for a number of our larger clients that have over married filing joint 10 million in assets that use the DST 2.0. They are able to get assets outside of their estates. They continue to grow, and that becomes a very useful estate planning tool to avoid what is known as the death tax, which is another, or the estate tax, which is another 40% on top of everything else. Meanwhile, creditor rights over the corpus of the trust are retained by your family. I say your family, or whoever you leave your estate to, because that promissory note that does pass from one generation to the next generation. Which, just to add another little detail here, whenever you use the DST or the Deferred Sales Trust more than once, so there's other assets coming in, you don't necessarily need more Deferred Sales Trusts. But every time an asset comes in, there is a corresponding promissory note for that exchange into the trust. And we do it this way so that it can be a long-term financial tool. And in fact, a long-term financial tool that outlives some of the original owners of the assets that go into the trust and becomes not only a financial tool, but an estate planning tool as well. Now,
Good job,
Jim,
Jake.
out of all of those answers, would you like any clarification and any additional questions arise?
I think just the one question, would a 2.0 be necessary to, like, let's say we didn't have a 2.0 set up and, you know, something happened and this flowed to our heirs and our living trust. Would they get like a stepped up basis from that? Would anything carry over? Like, what would actually happen if we weren't in the 2.0 at the time and this was passed to our heirs?
This is a great question. I'll take this one. So what is the consequences of not taking action? So number one, we, especially if you're ultra high net worth, but all of us, right? We should do what's called basically an estate tax assessment, which as it stands right now, if you are married, it's about 24, 25 million with adjusted for inflation of your net worth is not subject to what's called the death tax. Now we've been taught that swap until you drop 1031 exchange is the best all be all. But guess what? That only takes the tiger by the tail, which is capital gains tax and getting a stepped up basis. So let's do the scenario. Let's imagine, Jim, you're worth $54 million, you and your wife. And let's imagine all of it's in one apartment complex and you're completely free and clear right now. And you've been 1031ing for 30, 40 years, but you fully depreciate the asset. And you're like, hey, I got the plan. I'm just going to, die. The government, no stepped up basis. Kids can walk away at 54 million and they can walk away capital gains tax free. That is correct. You won on that one. You got him by the tiger there, but guess where the elephant's sitting there? It's sitting on the big side. And it's, Jake Miller likes to coin it the government's biggest mousetrap. That 54 million, let's just take the number. Let's just say 24 million is the exemption amount. That leaves $30 million that would be subject to the death tax, which has nothing to do with capital gains tax. That 30 million by 40%, that's $12 million, right? Did I do that right? 30 million by 40%, that's $12 million. Within 6 months, your estate, your kids would either have to refinance, sell, scramble around to pay the government that $12 million, right? Which is huge. Now, what's going to happen in 2025? Guess what? It's already set to expire, which means it's going to cut in half to 12 million. So now you go for a married couple, essentially, maybe 14 million for adjusted inflation. But let's just use 14 million as the number. So now you're looking, Jim, at 40 million inside of your taxable estate times by 40%. That's $16 million that's subject to estate tax. And so there's even talks of maybe that even going lower. So, we have to see what's going to happen there. But here's the key. With the Deferred Sales Trust Plus, we solve that without having to give any way to charity, without having to buy a bunch of life insurance, without having to have 50 kids and trying to gift it all away slowly over time. Those are the old blockbuster methods of doing things. We can sell that $54 million apartment complex tomorrow. We can move it inside of your taxable estate, outside of your taxable estate that next day. And if you were to die that next day, we've just eliminated that $12 to $16 million death tax. And so the answer is it's compelling to move now, right? Most people are not selling, and part of my background as a multifamily broker, I still am. This is what we do across the country, luxury real estate and multifamily brokerage, is looking at this at more of a tax flow mindset. Back to the beginning of why we're here, tax flow versus cash flow. Most people are looking at just the cash flow side of things, or even the capital gains tax side of things. They're not looking at the estate tax from a tax flow side of things and connecting those dots and saying, really, where are you at if these things happen? And when you go through it with that mindset and kind of a bigger macro view, all of a sudden it becomes very clear. The seller says, you're right. Not only should I sell, but I should sell now, because who knows where the market's going to be in 5 or 10 years. And who knows how my health may be in, 5 or 10 years, and if I can get it all out tomorrow, I've eliminated that. Now, here's the best kept secret. A week later, 6 months later, 2 years later, guess what the trust can do? It can go back and buy a property down the street, or maybe even the same property for $54 million with you in a joint venture partnership with a brand new depreciation schedule. So it's not as if you can't have your equity tied into real estate or the trust secured by real estate. In fact, you can have your cake and eat it too, if you will, right? You can have both. Now, hopefully you buy that deal not at 54 million, hopefully you buy it at 45 because the market shifted, right? Like we've seen in the last 6 months with a lot of multifamily owners saying, oh my goodness, I'm so glad that I didn't actually win that bid because that deal fell apart and the values have dropped by 10, 15, maybe 20% already from some of the peaks. So that's the bigger plan there is we're going to buy at optimal timing. We're going to eliminate that estate tax and we're going to build a wealth plan that's going to serve you and your family legacy for generations to come. Does that make sense, Jim? Excellent. Jake, do you want to add anything to that? Anything I missed?
Well, I just want to share a horror story, if that's okay. I mean, I know it's not Halloween or anything like that, but when people waited too long to do planning in regards to the estate tax, in the wonderful state of Texas, where they don't have any state income tax, but there is federal tax and there are estate tax or death tax applicable. There was a wonderful farming family of several children. I can't remember exactly how many there were, but it was like 6 children, right? The parents passed away and they were very, very dirt rich, but pocketbook poor. All their wealth was locked up in land. They didn't have a lot of liquid assets. Everything was in land. And we all know that land, there is a market for land, but sometimes it's 9 months, sometimes it's 2 years before land sells, depending on your market, right? These individuals, because of the untimely event of the passing of their parents, had to do a fire sale because the IRS essentially told them that they had 9 months to pay the taxes because it was a substantial amount of land and it exceeded the unified tax credit that you were talking about, Brett. Right now it's around 24, 25,000 married, filing, joint, everything else. And so everything that exceeded that amount based on a current appraisal that was subject to be appraised either the date of the death or 6 months after, they had those 2 choices, right? But it was substantial, yet they didn't have a lot of money in the bank. So what they had to do is they had to do a fire sale. What is a fire sale? I mean, essentially they had to urgently find a buyer, which meant that they had to sell at a discount. It was almost like the building's on fire, so sell what's left of the building as fast as you can and get out, right? They had to pay taxes on the appraised value. They had to raise money or liquidate based on the discounted rate that buyers were willing to buy, even though the appraised value is what they pay taxes on. Essentially, they weren't left with very much of the property value when everything was said and done. And it was just a terrible event altogether because they didn't do proper estate tax planning. So let's not be like that. That's why I'm sharing that story.
Thank you guys very much.
Yeah, Jim, great questions. Appreciate you. By the way, if anyone hasn't seen, Mike Schmidt might have a question. Mike, you're unmuted. How you doing?
Hey, so I work in the ag world with families. So can we use this as a method to restructure our holdings? Does it make financial sense for us to go through? I've got an example. We've got, family owns 1,100 acres, no debt. Much of it's been held for, it's gotten to the end of the depreciable window. Brothers are trying to think about what to do. And so they're trying to figure out, maybe one brother wants to go off and do some farming with some of his kids separate from the other brothers. I mean, is there a way that we could kind of think through the whole and tax the estate planning is in shambles? Like there's virtually none. So, it goes back to Jake's example just a moment ago.
Well, I would say it's a perfect time to start bringing all the financial pieces together to see what the options really are. for the Deferred Sales Trust as a financial tool, one of the eligibility requirements is that there is a sales transaction of some kind. So not necessarily an inheritance transaction, but a sales transaction. And so if parents are planning to sell a portion to one of the sons, that could equate to an eligible transaction. We oftentimes encourage people that, as a rule of thumb, like a home run, no-brainer, this fits with the DST. We oftentimes say that if it's $1 million transaction with $1 million capital gain, or if there's basis, let's say there's 400,000 in basis, then it needs to be a $1.4 million transaction so that we have $1 million capital gain event, because then that's like 200,000 because of the capital gains, another 3.8 because of the Medicare, and then any state taxes, right? And so that means that there's enough tax paying for it to make sense. That's a home run. Now, can we also do a base hit? Can we do smaller amounts? We can, but it's a case by case. Does it make sense? And is it interesting enough to the client? Is there enough tax paying? And so
there'd be $100 million. There would be $100 million capital gain.
That's definitely a home run. Million times another 100, and we've got 100 million. We're good with that transaction. That's very similar to a real estate developer deal that we were looking at here. Well, there in the state of Utah not too long ago. Which state are the clients in, Mike?
Oh, wonderful, California.
Cali taxation. Even more sense does it make. So similar to the deal that was audited 3 or so years ago, that was $120 million condo skyrise. Now, again, similar in the sense that in the dollar range, it worked for them. And even though it likely we'd set this up differently, because we're not selling to unknown parties, we're selling to a child. We'd have to get the tax attorney involved just to make sure that we're dotting all our I's, crossing all our T's. But that would likely be if they're not wanting to wait till the time of death to pass properties on, and then have all these life insurance policies and other means to pay that death tax so that properties can pass free and clear to the family members. If they would like to actually transfer ownership sooner, which sometimes is the case, the Deferred Sales Trust could be a very appropriate tool for that. They can even set up an installment sale for the future payment or payment over time of the farm to the parents that is actually redeemed through life insurance proceeds, incur the sales transaction now. Anyway, there's a bunch of different things that could be done, but we'd have to look a little bit more at the specific details.
Okay, thank you.
Now, it also seemed like they want one other thing. It also seemed like the brothers maybe want to do something different, or the sons might want to be entrepreneurial. This is a key point.
Mm-hmm.
Jake, do you want to add to that?
No, I was just going to say, a lot of times in this scenario, there's desires to have an estate equalization, where some people get the land and the dirt, and some people get money, and some people get other assets, right? And so there could be a lot of moving parts involved, where we apply several different financial and tax strategies to accomplish what the objectives of the entire family are.
However, the DST Plus, what's really nice about it, Mike, is that in one day, in one transaction, it does take a third-party buyer, and it could be for fair market value, by the way. So it could definitely still be a family deal if one son wants to buy out the parents, but it would need to be fair market value. But let's imagine we had a $100 million buyer tomorrow, and they're ready to buy all the land. And one transaction, one sale, we moved all of it outside the taxable estate. We've just eliminated basically probably $30 million, right, after the exemptions. And that's a big number there. That goes a long way for the family and the heirs to know that that's not going to be subject to that death tax, number one, or have to buy a bunch of life insurance, number two, or have to do any kind of major gifting or giving it all the way to charity. Now, you might do a portion of some to charity, and you might do a portion of some life insurance. It's not to say that the DST Plus may be everything to everyone, but it can certainly get that foundation of that cornerstone, the way Jake likes to put it, cornerstone strategy for that flexibility. And here's the flexibility, which is really neat. Let's imagine one son wants to just, invest into real estate or something a little more hands-off versus farm and ag. The other one still wants to do farm and ag. Can the parents with the trust joint venture partner with each son in different ways with the capital and do different ventures? The answer is yes. Right? The answer is yes, it can still work. In fact, you can partner with the trust on your own deals, but you can also partner with the trust with other partners. It could be, family. It could be just a friend. I mean, it could be anybody. As long as we're doing everything for fair market value, we're charging fair market, management fees on those LLCs that are buying different assets, and that's part of our role here. Capital Gains Tax Solutions, working with Jake Miller. We also work with Campbell Law to make sure that we're following all the things to really dial that in. Mike, do you have any thoughts or questions on anything that Jake or I just said there?
So if the real estate's held in different LLCs, this still works. We can go buy assets out of LLCs and then kind of reposition into something that would be favorable.
100%. And that's the biggest thing for $100 million. You have to ask yourself, what's the cash flow? And now we're going to look at the tax flow situation. Remember, land is not depreciable. I mean, they've probably been depreciating equipment, right? But there's only so much equipment you can buy. So in these scenarios, we often look that we're able to increase 30, 40, 50, 60, 100, 200% increase in cash on cash return. That equity in that land that's so highly valued can be redeployed into multifamily projects, mobile home parks, other ad projects, big businesses. So it could be a business part of it versus not just having the land. There's the diversification and the flexibility there. The key is, what do they want to do, right? What do they need to do? And how much time do we have to execute these things? And that's where we would love the opportunity to help you guys out.
So timing wise, if we had a 2 to 3 year window, we could probably get everything done over a 2 to 3 year window, probably.
We get stuff done in 30 days. We just did a $13 million deal in San Diego in 21 days from the time they saw our first YouTube videos to the time we closed. It took a lot of hustle. No one likes to work under those tight timeframes, but we were able to deliver. But yeah, over 2 to 3 years, is the longer the better, because you have chances to go to the conferences with us, to obviously be on these type of master classes, to meet with us in person, to fly to the bank where the money's going to go, to look at the investment plan. So the bigger the deal, obviously, typically the more time it takes. But as far as our end, we'll move as quickly as we need to if a deal is live. But it is better, you're right, to go early. So we prefer to be early, if that makes sense.
Well,
Okay, thank you.
To your point, Mike, with a $100 million asset within an estate, and there might be more assets outside of that. And well, I'm just speaking about some other people that I'm aware of, not necessarily your clients. Sometimes it takes a little bit of time to move assets around and to properly structure other entities so that the deferred sales trust really can be the cornerstone that helps piece everything else together for tax purposes. But oftentimes when there's other entities involved, and sometimes multiple family trusts, depending on if there's, a second wife or a second spouse, or something of that nature, some of those things do take a little bit more time. And we've got a number of other attorneys that are knowledgeable about the DST that step in for some of those other entity structurings that we can bring to the table, just to make sure that the entire plan functions correctly with the deferred sales trust.
Yeah, I think tenants in common might be necessary in some of this to facilitate some of the transactions. We'll have to do some conversions in order to facilitate.
Maybe, Mike. Here's the thing with the deferred sales trust. Generally, no. So in like 1031 exchanges, you're right. You have to do like a drop and swap or go tenant in commons to get them outside and get them separated so that the whole entity doesn't have to move. That's one of the major downsides of the blockbuster 1031 exchange. With the deferred sales trust, generally speaking, no. We could just assign the interest of the LLC, typically if it's the LLC, C Corp, S Corp, and prior to even the close, so that at the close, the interest flows through to each of the individual trust of the ownership, right? So in other words, I'll do the sale I did in San Diego, $13 million car wash sale. 4 partners, right? 1 LLC. And multiple interest in each of and they thought they had to do a 1031 till they met us. One of the sellers just wanted his cash. He just said, I want to pay my tax, no problem. He paid it. The other 3 assigned their percentage interest of the LLC into each of their individual trusts and separated the capital into individual trusts that are not commingled, never commingled, individual custom plans for investing. And that's the beauty of this. So it actually could speed up transactions where a lot of people think, oh, I've got to reorg all of this. Now, that being said, you could be right. There could be some things we do need to reorg. But this is the neat part about the tax attorney, Todd Campbell, who we work with. We call him the Elon Musk of tax. He was an M&A attorney, international. He's a genius. he'll look at this for, let's say 2 hours of all the information that you send, and he'll be able to put the pieces together. It's like a Rubik's Cube, and say, here's what I would suggest you do if you want to accomplish what you're trying to accomplish. And oftentimes it's much simpler than one would think, because the DST is so flexible, if that makes sense, Mike.
Sure. Thank you, guys.
Yeah, thank you. Good question. All right, we're over top of the hour here. So I don't know if anyone has any pressing deals or questions. I'm not even sure on my next meeting here. I might already be late, but while we're waiting for that, Jake Miller, if people want to get in touch with you, where can they find you?
Absolutely. They can reach out to the office at 1-800-773-1848 or go to strategictaxsolutions.com, where you can read up on more information, as well as there is a booking link for my calendar there at strategictaxsolutions.com.
Awesome. Pierce York, if people want to get in touch with you, where can they find you?
Yeah, you guys can reach me at kingdomluxuryrealty.com or our YouTube channel, living in Newport Beach, California.
Absolutely.
And on the podcast.
We also have Jake Carpenter here. I think he unmuted himself too. Jake, did you have a thought or question? He's one of our financial advisors that we work with out of the great state of Washington. Jake, how you doing?
Great. My comment real quick here is I am in an ag-rich area up here in the Northwest. And I will tell you that the Deferred Sales Trust is the best kept secret that is not a secret. That is the absolute game changer when it comes to ag. It is a foundational planning piece that can be used to significantly change the course and the direction of an ag family. So I think, you're on the right direction, Mike. So there is so much that you can do in an ag-based situation. Parents don't have to die in order to retire. They can equalize the estate. There's a lot of flexibility. So if someone wants to reach me, you can reach me at 509-591-9900. Talk to Sarah, book an appointment. I'm with Carpenter Capital, and great to see all of you.
Good to see you, Jake. Thank you so much. And if people want to get in touch with me, you can go to capitalgainstaxsolutions.com. Check out the new book that's coming out. It's called Building. I don't have the copy on hand me right now. Building a Capital Gains Tax Exit Plan is the new name, everybody. It's official. Okay. And we're about 30 days out. It's going to be really exciting. We're going to have like a book party. I'm going to ask for each of you to buy the book, by the way. I'm going to be pointing fingers now. Not really, but yeah, seriously. But if you can, that'd be great, right? Support the book. It's going to be a cool launch. And it's really about the story of how we're all here right now. And Jake Miller's in the book. We have the Kevin here, Shark Tank is on the book. And it's exciting opportunity to kind of spread the message of what's possible and overcome false beliefs with the Deferred Sales Trust. So look for that book. And if you want to dive into a consultation with myself, one of my team members, go to capitalgainstaxsolutions.com. Make sure you said you saw this meeting here. So appreciate that. That being said, please bring someone next week. Come back next week. Bring the CPA, bring the skeptical cousin, uncle, friend, business partner, whomever. Everyone's invited, and we'll hang out. We'll see you all next week, 10 a.m. Pacific Standard Time, 1 p.m. Eastern. Bye, everybody.